I think interest rates are moving lower, but here's the thing. Not everyone agrees. The Mortgage Bankers Association says we'll be stuck around 6% for years, while Barry Habib thinks we'll see mid-fives, and even Jerome Powell, the head of the Fed, seems to be hinting at a softer stance. So today, we're going to break down what the data really shows, what it means if you're trying to buy your first home in a market that's trying to find its footing. So Josh, I said I think they're going to be lower. What do you think?
I would be biased in that direction, but I also, what we're going to see is we look at some of this data and the way different people analyze the same data, and you look at it and go, and the big one, we'll go through this, and we've talked about it ad nauseum here on the show, as everyone else has, is the tariffs. The tariffs are causing inflation to be higher than it otherwise would be. We were on a nice trend lower in inflation earlier in the year, and if that were the case, with the same weakening jobs data that we've been seeing, we would have rates significantly lower than where they are right now, probably mid fives. So let's look at where we're really at, because now we've kind of seen two falls in a row, and actually late summer, early fall of 2024, we saw rates get down, closed many no-cost refis in the very high fives, 5.875, 5.99 this time last year. And then we got a spike of inflation data and really strong jobs data, which turned out to be incorrect. It was bad data. So Trump had to fire the head of the Bureau of Labor Statistics so we could fix that. But it did. Honestly, it's a methodology error. It's not a people cooking the books error. But with that, we can look back and see, hey, rates probably should have stayed lower longer. But then with the tariff regime in April, we actually had the 10-year drop down to 3.86 for a day when the shock and awe of these giant tariff announcements came out. So what that did for us is just a brief blip, and now we've been trending down for about 3 months. And again, lots of no-cost refis in the very, very low sixes. I told you before we came on, a buddy of mine who is literally a perfect borrower, 30% loan to value, big loan, perfect credit. He's going to pay a little bit. He's going to pay a quarter point and pay his own cost, but all the way down to 5.625. So we've been all over the place in just the last 12 months. In the last 18 months, from a high of 7.5 to a low of maybe 5.875 for 0-point loans with reputable lenders. So what does that tell us moving forward? Or more importantly, what are the experts that look at this and project for their industries, for their companies, saying about the future of interest rates over the next 12 to 24 months?
So Josh, let's kind of give some premise here. Where we sit today? Today, 30-year fixed, no cost or low cost, refinance. I'm buying a home. What does that rate look like?
So Mortgage News Daily is reporting right around 6.25 for the very best qualified borrowers. So 780 plus credit score, 25% or more equity. In the real world, when you look at either Optimal Blue or Poly data, which are real locked loans, they're seeing about 1/8% higher than that. So let's say absolute best to worst lender, they're all in that 6.25, 6 3/8 range for well qualified borrowers on a conventional loan. Obviously, government loans are going to be about 0.5% lower than that. All right. Just wanted to take a quick minute to say thanks, amigos. It means so much to us that you spend your time here with us every week. When we started the show, it was just a couple of guys trying to make sense of the real estate and mortgage world. And now we have thousands of you showing up every week to learn, share, and laugh with us. That is truly wild. And honestly, we're just getting started. If you've been listening for a while and haven't hit follow yet, go ahead and smash that button. Less than a third of our regular listeners have, and it helps us grow the show more than you might think. Our goals here haven't changed. Keep finding the best guests, the best info, and the best ways to help you navigate your path from educated homebuyer to educated homeowner. Once again, thank you. We're grateful you're here, and we can't wait to keep it rolling.
Got it. And you and I started the year. We typically do a forecast at the beginning of the year, kind of a mid-year forecast as well. And I'll be completely honest, don't 100% remember what I said back in January because so many things have happened since then. But I believe we were saying, hey, listen, low sixes, high fives were probably where interest rates were going to be. And I believe Logan Moashami, Housing Wire, his forecast was somewhere between 5.75 and I think 7.25. So a really big range. And at the time we're filming this, we're at the lower end of that range. But I personally believe that we have an opportunity to go lower because of a couple of things out there, which we're going to talk about in today's video. But let's talk first about some forecasts that some of the major, conglomerates, if you will, are saying, like Mortgage Bankers Association, CoreLogic, those guys.
Absolutely. So Mortgage Bankers Association came out with their projections this week. So that's the one that's been in the headlines. A lot of comment, some pushback, some, yeah, that's about right. And before we go into their numbers, I want to step back. Fannie Mae put out their numbers, what was it, 2 or 3 weeks ago, Jeb? And they were kind of insane. At that time, rates are at 6.375, and they're saying we end the year somewhere between 6.5% and 7%. And you're like, you think rates are getting worse between now and the end of the year, which, as crazy as it sounds, we always amaze ourselves, Jeb. It's middle of October.
I don't want to push back on that, but I don't think it was that high. I thought they said 6.4% is where we would end the year.
It was wrong. We can dig it out. Either way, it was above
it was
where the rate was at.
Agreed. I do agree.
And rates are trending down. Rates were and continue to trend down. So it looked like a pretty crazy call for the near term. If we're talking, it's easiest to forecast over the next 60 to 90 days. If you ask me 6 months, 12 months out, and any of these experts that we're going to be quoting today, it gets much, much harder. So on that topic, the MBA came out, and the part that was interesting is they did their forecast all the way through 2028. So 3 years from now, where are we at? And they are predicting that we're going to be in a range, 6 to 6.5%. So if we're in the middle of that range right now, we just talked about, they're seeing maybe we get a dip a little bit, maybe we pop up a little bit. So depending on what you're looking at, if you're looking at it today and you're wanting and hoping for lower rates, you're like, well, this sucks. They don't think rates are going any lower. If you look at it from that time frame, early this year when rates were 7 1/8, 7 1/4, almost to the high end of Logan's range for about a week or 10 days, you'd say, well, this is pretty good. So historically, a decent interest rate. Recent history, much better than what we've seen. But at the same time, what people got used to over the last 15 years, it's a high interest rate and not something that would be super accommodative to further improvement. When we get to the section here where we go through Logan's data, he's talked about, and he quotes the data, when you get below 6.625, then we see applications pick up, we see transaction activity pick up, but it's not linear. It's not like, hey, at 6.625, we flipped an on switch. It starts to tick up. The lower this goes, the more activity we get because affordability improves and people are more comfortable making decisions to buy their first home or to sell their current home with a really low interest rate and buy a new home at a higher interest.
Well, I think it's important to note, too, that the MBA didn't just put out a forecast to 2028 like out of the blue. They always do a 3 to 4 year forecast. I mean, it may even be 5 years. They tend to go a lot further out. But I'll also say they don't really have a good track record of nailing where interest rates are going to be either. So, I mean, we got to take this with somewhat of a grain of salt in considering what their ranges are. But I think also, Josh, correct me if I'm wrong, when they give a range, they're kind of giving an average. They're not saying, hey, listen, interest rates can't go below 6% or above 6.5%. They're just saying, hey, listen, but this is essentially what the average is going to be at this given time, right? So it doesn't mean we can't have these little blips where interest rates drop to 5.75% for, a week, a couple of weeks, and people are able to take advantage of it, and then they trend higher, and then the average ends up higher or longer down the road.
They did actually say they expect that would happen, that you would get these brief dips where you would see an increase in refinance activity. Because if you get a brief dip, 6-8 weeks, in reading through a bunch of Logan's stuff here just the last couple of days preparing for this, I think he said we need 14 weeks of increasing mortgage purchase application data before that will trend into more sales activity and potentially higher prices, but more so more activity. So when we look at that, if you get a blip for 4, 5, 6 weeks, you will absolutely see a bunch of people who bought at higher prices jump in and take advantage of lower interest rates, but it doesn't really impact buyers because it just takes a little longer, right? You have to think on it for a minute and say, hey, is this the thing that's going to cause us to pull the trigger? Okay, yes. Now we got to get out and look at some houses. We got to get one under contract. We got to go through negotiations. We got to actually close it. It's a 60 to 90 day process in the best case scenario. So when we look at that, let's look at why the MBA is projecting this. The things that they focused on in their press release with this was sticky inflation. And I don't know, I still have a problem with this sticky inflation, because I don't think we have sticky inflation. We have tariff-based inflation. So it's not like inflation just stuck around because there's underlying things that kept it here. We have higher inflation because of the tariffs, which, as we've spoken about a million times here on the show, should be a one-time adjustment to prices. And we're talking about started seeing those late summer. So early part of next summer should have worked its way through the system. And we'll go into that in a little more detail in Barry's projection here. A big thing that is important that the MBA focused on is fiscal deficits. They're saying, hey, if the government can't pay their bills, they have to borrow money. That's additional supply in the treasury market. Treasuries are generally preferable because they're lower risk to mortgage-backed securities. So additional supply in treasuries, even if there's no additional supply in mortgages, will pressure interest rates higher. So it will remain to be seen what happens there, because interest rates coming down themselves limit the required government borrowing, because now they are borrowing to pay interest on previous borrowings. So as crazy as that is, it's sort of this
pyramid scheme.
Lower rates would be the opposite of a doom loop, but the higher rates would be a doom loop there. So it's very important to watch. Could they be right? And if they're right, they could be more right than they want to be, and it could actually lead to higher interest rates. So all of that leads them to believe the 10-year is going to be right around 4%. And for the better part of 10 days, that's right where we've been. A couple of times we've ticked down to 3.98, 3.99, a few days up at 4.02, 4.03, but right there at that 4% range. We've talked about it on the live show a bunch. Jeb, you always throw up the chart of spreads, or most weeks we show the chart of the spreads, meaning what do mortgage rates look like relative to that 10-year treasury? And that has been normalizing. We had blown out at the worst level over 3%. So whatever the 10-year treasury is, you'd have rates 3% higher than that for mortgages. So if that were still the case, you'd have 7% plus mortgage rates today, but we don't. We're in the low sixes, which is still a larger spread. So 4 to say 6 1/8, 6 1/4 is about a 2.25 spread. Long-term averages have been about 1.7. If we expect going forward with less government buying that those averages would tick up, 1.9, 2.1 is reasonable to think there. So if they're right and the 10-year is in that 4% range, probably tells us rates around 6% and can still see some improvement from here, even if they're correct on their projection on the 10-year.
All right, good stuff. So now let's talk about the Fed a little bit. The Fed and some of the statements that Jerome Powell has recently come out and said. Since the data has essentially been on hold, right? The government shutdowns happened, and then since then, Powell has actually come out and made a couple of statements, which is part of the reason that I do think we can see lower rates potentially even this year. I'm not calling for 5.75 or 5.5% like our friend Barry is, but I think there's a possibility that interest rates drop below that 6% because of these few things that we're talking about here, Josh. So let's start with, just some of the comments that's come out from Fed Chair Powell, and basically admitting that the labor market has softened, and also this idea that they're nearing the end of quantitative tightening, and essentially that's big. That's big for interest rates in the future of interest rates, if you will.
And just a super simple explanation. Quantitative tightening is the opposite of quantitative easing, which was a new monetary policy after the great financial crisis that they brought back and thought that it would never need to come back. But during COVID, what they did is they bought treasuries and they bought mortgage-backed securities to bring interest rates way down in an effort to stimulate the economy. It brings rates down further faster than just working with the federal funds rate. So then the opposite, they end up with this big balance sheet. Now that they were buying all these treasuries and buying all these mortgage-backed securities, that's not their role, is to hold those assets. So they've been selling them back into the market, which creates additional supply with a finite amount of demand. So those prices go lower and the yields or interest rates go higher. So if they stop doing that, that additional supply is no longer out there in the market. We talked about if the government keeps borrowing more, that's additional supply. But if the Fed, another arm of the government, stops selling as much, that's less supply. That would be an impetus to improve interest rates, and probably at this point have a bigger impact on mortgage rates than what we've seen from Fed cuts, or are likely to see going forward from Fed cuts. We've seen a nice drop in interest rates, but that's based off of already having seen one cut and the market almost fully pricing in 2 more cuts the rest of the year. So the cutting regime has already kind of been priced in. This has not, unless you say that some of the buying over the last week since he announced this was due to him indicating this stance coming.
Well, I think there's probably part of that, right? I mean, at the time we're filming this, the 10 years under 4, 3.9 something. So I think part of that's probably from some of these statements. I think part of it also, goes under the idea that the Fed is probably having a little bit softer stance in the market in general, and that, additional cuts could be coming in 2026. I mean, I don't think you're going to have more than two this year, unless you just have some super weak data that were to come out and you could get the possibility of a larger rate cut. But at the moment, the market's not pricing that in, which is huge, just in general, because, hey, we now know the Fed is starting to change that stance, and very transparent Fed leads to mortgage rates kind of leading the market in a sense, right? So the Fed comes out and makes these statements. The market kind of follows that before the action ever takes place, right? So they don't need to cut rates. They don't need to stop selling treasuries. They can just talk about doing it, and the Fed and then the market reacts to that data. But with that said, Josh, that's the Fed stance. Let's talk about friend of the show, Barry, and he's probably the most aggressive here in where he thinks interest rates can go. But he also has a history of being pretty damn accurate. If
That's what I was going to say. People who like to criticize Barry will say, "Oh, he's a perma bull, always thinks interest rates are going lower." But Zillow does an industry forecast that they track everyone, and he's won 3 or 4 times among like 30 or 40 of these forecasters. He has been the number one at least 3 times in the last 10, 12 years. So a very accurate history here. And he's saying possibly, he's not calling for this, possibly mid fives by this time next year. So another 0.5% lower. And we've seen people get hung up on, we haven't been there for so long that, oh, this is impossible, this can't be. Rates move fairly quickly. Like last year, between summer and fall, we went from 7 to 5.99, like really, really quickly. So it can happen faster than people think. But why? Why is he projecting that? And it's because he expects inflation to cool from where we're at. All measures, whether you want to use Trueflation, CPI, PCE, every measure is inflated and higher than what anyone wants it to be, and largely due to the tariff pressures. So if we look at those tariff pressures, they should subside over the next year. And what we have been seeing is, as the economy cools, as we have a lot of additional housing supply coming online, not so much housing for purchase, but housing for rent. During COVID, a lot of buildings were financed that have just been finished, completed, and come into the market. We're seeing rents moderate massively relative to what was a large component of that inflationary figure the last few years. So he believes, thanks to shelter coming down, that inflation will moderate towards that 2%. The Fed is going to continue cutting, and we're going to see the 10-year under 4% with continued narrowing spreads. So even if you get to, let's say, a 2% spread with a 3.75 10-year treasury, that's a 5.75 interest rate. And I would think that if you were to ask him, that's kind of his base case between now and the end of the year, is that we see another 0.08%, barring something unforeseen when the government opens back up and we get a flurry of 6 weeks of data. It's only 3 weeks now. So depending on when the government opens back up and how quickly they get all that data out, we're going to get a couple of jobs reports, a couple of CPI reports, although they said that CPI we are going to get here at the end of the month. So with that, it's I don't disagree. So he says we're on the verge of meaningful improvement once data catch up to reality. So we've talked about the lag in the inflation data, some other pieces of data. He thinks that will continue to catch up and you will continue to see improvement in interest rates. Now, he's not calling for a 5% interest rate, but continued improvement through the rest of the year.
No, good stuff. And he also has a role now in the government, not to be political and that they're, sharing secrets with one another. But I like to think that if you got your hands in the cookie jar, you're probably going to come away with a cookie at some point. And so I just made that up. I don't even know if that makes any sense, Josh. But, I like to think that, hey, having your, being in the mix probably gives you a little bit more insight as to what's truly happening out there. But again, to be determined. So now another friend of the show, Logan, we talked a little bit about him earlier. Has had a range for the last, year and a half or so at least. 5 at 0.75 to 7.25. We've essentially kind of pushed both ends of that boundary to some degree over that 18 months or so. But what are his thoughts?
Very similar. So the 10-year is been for the last few weeks in that 4% range, which tells us rates are just a hair over 6. So to get to his 5.75, which is the low end of his projection for this year, to see that by the end of the year, we have to get a break below 4%. So sort of the cheat code for those of you watching at home, you know, whether you want to look at Mortgage News Daily every day or Optimal Blue Mortgage Market Index, just watch the 10-year. You can get that. You Google that, and it will pop up and tell you what that looks like. If the 10-year breaks towards the 3.8, 3.75 range, you're going to see that 5.75. Again, we talked a little bit earlier. Many of these things are important. Once we get below 6.625 on rates, we see purchase applications pick up. And that's been pretty consistent. 2025, it's from a very low base in 2024. 2024 was when we saw purchase applications bottom. So we have had nearly every week this year with year over year increases in purchase applications, and most of them double digit increases. So again, coming off a very low base. So if you have like $1 and you get one more dollar, you just doubled your net worth. So it doesn't mean you're rich. It just means that you started from a very low base. That's kind of where we're at. But we see more and more activity the lower interest rates get, because as we've talked about a billion times here on the show, it largely comes down to affordability for first-time homebuyers. They're saying, can I afford to do this? Is this prudent at these prices? Is the premium to own a home relative to renting worth it for all of the benefits that I get? Fixing my housing costs, building up equity, getting tax deductions, stability for my family, all of those things that people over time have proven to want. Is it worth the premium that I have to pay right now? Well, the premium gets lower and lower as rents continue to inch up, and hopefully we have mortgage rates continuing to moderate.
Well, one thing I'll say about Logan is that, in my opinion, he's been probably the most accurate over the last couple of years. He doesn't necessarily forecast interest rates, which I think is a positive thing to some degree. He just looks at his model and says, hey, listen, this is essentially the range that we're going to play in. And, you know, while Barry and a couple of these other guys and Fanny and even Lauren Chun, who we're going to talk about, are constantly trying to nail an interest rate, he's giving more of a range. And I think that range has proved to be pretty, accurate, as we mentioned. And so, it hasn't changed. So those people out there at the moment looking for, say, 5.5% interest rates, 5% interest rates, thinking, things are going to improve dramatically. If you're looking at his model and his theory, if you will, is that we're still in this. Like, it hasn't changed until I think you break 3.8 something. Does his model become somewhat, we're going to say, irrelevant? Well, that probably isn't the right word to use, but until we're breaking outside of that and staying outside of that range, this is where we are. So if interest rates get down, around there, it's probably prudent if you're refinancing, even now. I mean, interest rates, low sixes, high fives for some of you out there. If you're in a potential to refinance, it makes sense. I wouldn't be sitting here waiting for even lower rates. I'd probably take advantage of it with the idea that, hey, listen, we could pop back up for a couple of weeks, couple of months before we trend back down. So, take the money as it's available. If Josh and I can be of assistance to you, there's, a link in the description of the video helping hundreds of you here on YouTube. And we'd love to guide you through that process as well. So, Josh, let's talk about Lauren Chun, National Association of Realtors, chief economist. Right, wrong. What are your thoughts on his stance?
Well, let's go with his money quote here, which is, people should consider 6% as the new normal, maybe a little above or below. And that quote is actually a few months old, probably like midsummer, from a speech that he gave. And when it came out, I'm like, this is crazy. 6% is the new normal, because I'm biased towards lower rates over the intermediate term. So if we say that, I'm like, I don't think we should be anchored towards 6%. But we just talked about the MBA, Barry Habib, Logan Moashami, three people who follow this very closely with very educated opinions about it, giving us a pretty similar range, right? 5.75 to high sixes. So 6% is the new normal. It is the new normal for now. Let's have this conversation next year, because what would have to happen to make all of these four experts wrong, where a 6% rate is just unreasonable? You would have to get a downside surprise, meaning that inflation moderates much faster than anyone is expecting with the tariffs still in play. The employment market would have to crash much, much harder. The Fed would have to basically do something different with their cuts and their balance sheet for that quantitative tightening, and or the government would have to magically get religion and stop spending more money than they have. So one of
Well,
those,
I can tell you one of those is definitely not going to happen. I'll let you pick which one it is.
So one or more of those things has to happen for a downside surprise. And then the flip side, it's still the same elements. The flip side for an upside surprise. Let's say rates shoot back up to 7%. Well, what happened? Inflation spiked higher than anyone expected. The jobs market was more resilient than anyone expected. The government spent even more money and borrowed even more money than anyone expected. So all of those things, if you ask me, I am biased towards lower rates because I think that is the more likely thing to occur. But if you pencil those things out and you say it out loud, you go, what's easier to occur? It's a negative shock that would push rates higher is a little bit easier, especially after 2 or 3 years where rates have not moved back down as appreciably as most people wanted, hoped, or expected. The market is just kind of gun shy. So that move downwards is going to be a slow grind lower. Whereas anytime we get a shock to the system, they pop up rather quickly. So feeding back to you what you said, hey, if you have an opportunity to get in a property that you're happy with a payment that you're comfortable with at today's rates that are much lower than where they were 3 months ago, lock the interest rate, keep it low in terms of not paying a bunch of points and fees. And let's look at if Habib is right this time next year and they're at 5.5, you're 6.125, 6.25. We can roll that down with a no cost refinance and have a nice $300, $400, $500 savings, depending on how big your loan is.
No, and I think that's the thing. If you're out there in the market, you're trying to refinance, don't follow interest rates every day. You're gonna drive yourself crazy, right? We have a refinance watch list that you can become a part of. There's a link in the description of the video. You put in your information. We'll ask you some basic questions and then follow interest rates for you, so that when it does make sense, just reach out to you and say, hey, listen, this is where rates are. You want to move forward? You want to wait? And then ultimately you make the decision. But also at the same time, if you're in the purchase market, get pre-qualified now. Where interest rates are today, know where you stand. And then if interest rates move lower before you purchase, hey, it gets even better. Maybe you can qualify for a little bit more. But I think just waiting is what kills most people, most deals, and ultimately, just kind of put you behind the 8 ball. So take advantage as it presents itself. And then lastly, Josh, buy right, borrow smart, build wealth. Till next time, adios.
Amigos.